This episode was co-produced by Deep Tech Nation Switzerland Foundation, a non-profit foundation committed to sustainably improving the framework for Swiss startups, scale-ups, and investors in the deep tech sector. Their goals are to mobilize 50 billion Swiss francs in venture capital and create 100,000 jobs within the next 10 years, making Switzerland the world-leading deep tech nation. Check out how they can support your business journey at deeptechnation.ch. Again, that's deeptechnation.ch.
My perspective might be in the minority because we're always the VC that's telling founders to maybe raise less money. When they're like, we got an offer for 8 million. We're like, 8 million? What are you going to do with 8 million? You have 300K of ARR and you don't know which customer base you want to focus on. What are you going to do?
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Sylvan.
Geri, a very well welcome to the Swisspreneur Show. It's a pleasure to have you as a guest today.
Thanks so much for having me. It's great to be here.
You are a partner at Laconia, a seed stage fund focused on B2B software companies. Before we talk about your career as an investor, I want to go back in time a bit. You graduated from NYU Stern, the School of Business. And I just wonder, as a young graduate, what were your career visions? What did you want to do with your career and with your life back then?
It's a great question, right? It's nice to look back sometimes and see how far things have come. For those who don't have a lot of context maybe on NYU Stern, it's a very, very banking-oriented school. It's like banking is number one, consulting is number two, and then everything else barely exists in terms of where they funnel students into. And I actually ended up there because I was much more interested in the business side of things and the entrepreneurship side. And so my expectation was that I would learn a bunch of fundamentals around entrepreneurship, starting companies, business operations, growth. And that was always the side that I was much more interested in. And when I graduated, I had already spent some time at 3 early stage venture capital firms. I had spent time with some startups, with some small businesses, and I always imagined myself in that much more entrepreneurial environment rather than the large corporate scene. And so, when I graduated and shortly after I joined Laconia full time, I think my expectation was that I would be on the investing side for a couple of years, and then I would either start a company or join a startup, maybe one of the portfolio companies. I think those are usually the more traditional paths for people who go into venture straight after undergrad. But Laconia just kind of ended up being an interesting 2-in-1 where the company that we built from the ground up ended up being this new venture capital firm.
That's amazing. We'll talk about that, of course. One of the VC jobs that you just mentioned was an internship at Credo Ventures in Prague. So you took the jump from the US over here to Europe. And I was just wondering, did you experience any culture shock? Because although we are all in the Western Hemisphere and sort of similar, I'm sure there were also very significant differences between Europe and the US back then.
Credo was my first VC job, so I have a lot of fond memories about that experience and that entry point into the industry. In terms of a culture gap, I'm originally from Bulgaria. I've spent a lot of time in Europe, so I think there was a lot of comfort and familiarity and just generally the sense of humor, the self-criticism, the self-deprecation. So I think in many ways it didn't feel very foreign. But in terms of the professional landscape and the tone and tenor, there were definitely big differences. As I'm sure everyone's aware, there's a tremendous amount of technical talent in Central and Eastern Europe and in Europe more broadly. And that really comes to the forefront. And the US, although it of course also has that, has much more storytelling and salesmanship and a history of really telling big stories about big visions. And it kind of felt like everyone was always underselling when I was in Central and Eastern Europe. And it really brought to my attention kind of the polarities that can exist in these ecosystems. And it brought to the surface some areas where there might be a role for someone like me who can maybe marry the two skill sets. So I think that was really the big thing. There was so much technical talent, not so much on the sales and go-to-market side inherent in the ecosystem, and a lot of growth potential to really bring those two together.
Amazing. And then in 2016, you joined Laconia as an intern as well. And back then, I think the founders somewhere said that they had little understanding of what it meant to build a venture fund. So please also take us back there. How was it to join the VC at such an early stage?
My two partners, Jeffrey Silverman and David Arcara, they are both entrepreneurs and operators for their entire careers. So they know a whole lot about starting companies, building businesses, operating companies, all that nitty gritty. They're also excellent at sales and marketing in particular. But realistically, both the two of them and me and anyone else who we brought onto our team, none of us come from traditional established VC firms. And so we had a blank slate when we were building the firm to think about how we want to do this. And I think this manifested in a couple of key ways. When we first started out, all of our service providers and our partners, when it comes to legal, accounting, fund administration, all of those functions were outside the traditional VC industry list. They, some of them were much more focused on private equity. Some of them were outside of the New York or San Francisco ecosystems. And that gave us a level of independence that I think in some ways sheltered us from a lot of the more network-driven boom and bust cycles of the industry. So we were always kind of adjacent when it came to those industry partners. The other thing is, when you start a venture firm on day one, you show up and your inbox is empty. It's like when you start a new job, you get your corporate email address, you log in, you're super excited, and there's nothing in your inbox.
Right.
So imagine you start a firm, nobody knows who you are. You have no inbound deal flow to start as a firm, and you have to think through, what are we going to focus on? How are we going to build our operations and our systems? And how are we actually going to operate? And I think we ended up just creating all of these processes ourselves. So we have always been very proactive about screening inbound opportunities, whether they're warm or cold, and we can talk about that in more detail. We built our own due diligence processes and these extensive checklists and investment memo templates that we designed ourselves and then over time became known for with some of our co-investors who would bring us deals and ask us to lead it.
Amazing.
We ran open hiring processes for any of our internship programs. We would publicly post the application, get hundreds of applicants, review all of that. So we just had a slightly different philosophy than the more traditional insular network-based approach. When it comes to even things like our due diligence, we've always taken a team-based approach. So we don't have separate books of business where that's Jeff's deal or that's David's deal, and then, the investment committee shows up and votes at the end of the process. We all get involved pretty early on once we know that there's something that we like, and we bounce things off of each other and we put our perspectives together. So I think that team dynamic and that decision-making process looks very different for us because we didn't come in with any pre-existing assumptions around this is how venture is traditionally done and this is what we're going to replicate. We tried to really think about it from the ground up and see what makes the most sense for us and where's the opportunity for us to build something differentiated in the market.
Very similar to entrepreneurs. This then allows you to do things very differently than the traditional people would do it.
Exactly.
So a lot has happened since 2016. You've also been promoted to partner. And just to give people a bit of a better understanding, I wonder, how does your day-to-day look like? What's a typical day in your life as a partner at Laconia?
Yeah, it's not that different actually from what it was when I was an associate. The associate role at Laconia is really good. I think the biggest thing that has changed over time is we now have the internal capacity and the team infrastructure where a lot of the execution pieces on a day-to-day basis are taken care of. I'm very grateful that over the years I've had the opportunity to basically play every role in the business, right? Everything from setting up our Google Drive folders to drafting our PPM to participating in fundraising when we were raising our previous funds. So it's been everything from the nitty-gritty execution to more of the strategic things. These days, we have an excellent fractional CFO, a head of marketing, an investment associate who can do a lot of that execution. And so my time can be, frankly, a bit more external facing, even though my default mode is heads down, buried in a research paper of some sort. Yeah. But it allows me to have a bit more time to meet with founders, work with our portfolio companies, manage the relationships with the VCs, co-investors, LPs, really kind of expand our network and our presence. That could be going to different conferences or attending events or in many cases speaking at some of these, and really just making sure that we are thinking about how we're improving our systems, scaling our reach, expanding our network, deepening our understanding of the sectors that we're really focused on, and ultimately driving toward the outcomes that we've promised our LPs.
Amazing. I love that. And you're focused on B2B software companies. So I wonder, what is the root of this focus of your investment strategy?
Nowadays, that is the most generic investment focus anyone can imagine. It's become so popular. But when Laconia started a decade ago, there was this notion that you couldn't generate venture scale returns without consumer, right? If you don't have a Facebook in your portfolio, what are you even doing? Mm-hmm. And of course, that perception has changed over time as we've had massive success stories in the B2B and in the enterprise space. But from our perspective, we had looked at what are the areas where we see repeatability, where we see outsized potential, and where it makes sense for us to play. None of us had hardware backgrounds, deep tech backgrounds, and we really were focused on companies that fundamentally had strong unit economics, could grow in a capital efficient manner, and where we could make decisions in a repeatable fashion, where you could identify a problem, quantify it, evaluate the solution, quantify the value, and make a decision, versus the much more outlier-driven nature of consumer that's super contingent on just personal taste, right? It's very hard to know, are consumers going to love Snapchat or TikTok or both? So that was really the inception. I think over time, we have evolved away from being so parameter-driven, right? I guess when people hear what we invest in, they often imagine us kind of checking off the boxes. B2B, software, early stage, this valuation, right? Where in reality, we're looking for the underlying principles, right? Do we think that this has the potential to perform in the way that we expect it might? So we can be flexible about kind of those mechanics. And we've always been thematic investors. We're not explicitly thesis driven. We tend to aggregate around categories like retail tech, ecommerce enablement, proptech, fintech, and increasingly digital health. So we are always looking at different sectors. And thematically these days, disruption has become such a constant in the world and in many of these industries, whether it's geopolitical, technological, there's always a new crisis to deal with. So we're thinking about our investment thesis and the way that we think about what we're looking for these days through the lens of anti-chaos investing.
I love that. On your website, you say there's no warm intro needed for these companies, that you focus on. Very many VCs, they would not write the same sentence on their website. There, you often need a personal introduction through an existing founder of their portfolio, LPs, whoever can make an introduction. Usually, you cannot just send them email and hope for an answer. With you, it seems to be different. People can just submit their pitches. So how do you evaluate them? Because I assume you then must get quite a significant amount of inbounds wanting to get funding from you. How do you make sure that you select and filter through them?
We do. We get a significant amount of inbound. We also get a significant amount of warm inbound through these referrals or introductions. And the reason we look at the cold ones as well is because there's often not that much signal in the warm ones either. Yeah. So either way, we have to look at all of these companies. One of the things that we've noticed over the years is that there's actually significant overlap between what comes in cold and then what eventually comes in warm. So if there's a company that emailed me while I was on vacation, for example, I come back to the office, I look at the company, and then I see that, my colleague is meeting with them tomorrow because while I was gone, they got introduced to someone else. It's like, okay, there's clearly reasonable opportunities in our cold, and often will be faster to meet with them if we review it that way, because the more efficient, the more direct path is always going to be if a founder has a list of companies, a list of funds that you can just reach out directly versus figuring out who's the connection, waiting for the intro, figuring out if it's a strong enough connection, which often it's not.
True.
So that's how, that's the rationale behind why we look at these. And we have made multiple investments that have come in cold that we have then gone into due diligence, led the rounds, et cetera. The way that we review them, which was your original question, is a combination of time that we spend and tools that we use. So we've built integrations with our CRM so that we have kind of a shared view across the portfolio and the things that we're looking at. And we actually recently implemented a tool that provides additional context at the screening layer that enables us to kind of focus our time on the opportunities that are better correlated with what we're looking for. So we know that there's never going to be a tool out there that will make the decisions for us. We still have that responsibility, and that's probably a good thing. Otherwise,
yeah, luckily, I would say.
Yeah, luckily, right? Otherwise, we'd be out of a job. But there are tools that can definitely help us focus and help us filter out the things that are outside of our scope, outside of our realm, and enable us to make those decisions a little bit faster.
Got it. In that sense, I also, when we did the prep call, you mentioned something that really stuck with me. You said for founders, they often chase these intros so badly, and they sort of maybe not forget, but at least neglect to actually work on the business, to build something that you eventually want to invest in. They're so intro focused. Is that something that is going a bit wrong in the startup ecosystem?
I think founders are put in a very difficult position with these sort of cultural requirements around the intros. Originally, the purpose of these intros was that there was signal in that recommendation and that referral. It's an endorsement. It's someone coming to you and saying, hey, I worked with this person at my previous company. They're the smartest person I've ever met. They're starting a company. You should talk to them, right? That's a valuable introduction versus, if you have 20 deals in your inbox, you're going to want to look at that one first.
Right.
That's a measure, right? There's some sort of information that when you make that a goal and you tell the founder, go get all these intros, you can't possibly create that kind of history if it doesn't already exist. So you end up with kind of this like SDR driven numbers game where, sure, you're technically getting the connection, but there's no push behind it. And I think that's just a big time waster. Unfortunately, I think that's the reality that founders have to navigate and balance. But I think it's important for founders to understand that not all warm introductions or all referrals are equal. And if there isn't sort of an implicit or an explicit endorsement there, they might actually be better off writing a super tailored cold email that's specifically to the person. For these reasons, we think you're interested in what we're building. And here are the key things that are signals of our growing momentum that should make you want to take a look at this deck. Yeah. And that's the piece around the business building. I think for founders, the fundraising is always going to be the least hard. It's never going to be easy, but it's going to be the least hard when you have certain growth and momentum and repeatability for at least a 3 to 6 month time period where someone can look at it and say, okay, I see the trend line and I see the direction that it's moving in. And I think until you have that point in the business, no matter how many referrals you get, you just have too many risks that are stacked on top of each other to make that really surmountable for most investors.
So it's really about differentiating between meaningful and not meaningful intros in that sense. Where do you get a push from it, and where is it just the intro, not really that meaningful?
Absolutely. And for us, in a sense, like the lukewarm intro is fine. We're not going to disregard it. We'll look at it the same way that we look at our cold pipeline. But, often it's just, hey, I met this company. Are you interested in learning more?
It's not going to put you ahead in that sense.
Yeah. We'll still look at it because our thesis is we don't know where these companies are going to come from. But all else equal, if it's going to take the founder 3 days to get that lukewarm intro versus to just email me directly.
I think that's also a good reminder for people who actually help out with these intros, right? That maybe it's better to say no, to say, look, I don't know the person well enough, or we have never really worked together. I cannot really endorse you in a sense that would be helpful for your company. So it's maybe best if I don't give you that intro.
Definitely. Yeah, I think that transparency goes a long way. And I know, this happens. I think everyone's been in this situation too, where you don't know someone super well. They ask you for an intro to a person.
Exactly.
You pass it along. Maybe you give context, maybe you don't. Then for whatever reason, it's a terrible fit. And then it's a reflection on you. I actually think we make things much harder by requiring this third party.
Yeah, and then it's sort of a lose-lose for everyone involved.
Absolutely.
Right?
And all the time wasted. So anyway, I could go on about this for days.
I think we get the message, and it's really important to reflect about that and how we can improve things. So once you got the connection established, no matter whether it's an intro or a cold email, what happens afterwards once you looked at the pitch and you say, this is actually interesting, I want to take a second or a closer look. What do you do after that?
Yep. So we get the information somehow. In most cases, we have a pitch deck. We look at it. We decide, first of all, we don't have any competing investments in the portfolio. It looks like it's roughly in our sweet spot in terms of stage and sectors of interest. And then any one of us on our team will do an initial 30-minute call to just learn a little bit more, get the full context. After that call, we'll usually regroup internally, or sometimes directly right after the call that you're interested in learning more. And then our second meeting, almost in all cases, is a meeting with our full investment team. So all four of us will get on a call with the founder and basically do it again.
Yeah.
And that allows us to all get on the same page and make sure that we have equal context and that we're able to bring our complementary perspectives to the table there. What we don't want to do is have one person dive really deep, understand everything about the opportunity and market, and then have the rest of the team with very limited information have to make a decision.
Yeah, you can't. Or it will not be a good decision,
Not a good decision, right?
Yeah.
There's just things that you're missing, and it takes time to understand the details and the nuances of most of these businesses. So we try to get everyone on the same page. If everyone is in agreement that it's worth digging in further, then we'll kick off our due diligence process, which consists of really diving into the operations of the business. So we'll often do a financial model walkthrough as the next step, even at seed. And then in parallel with that, we try to make 3 to 5 prospective customer introductions from our own network so that we can get some real market feedback and then also generate some sales leads for the founders. So in that financial model walkthrough, we're really trying to understand the logic of how founders are thinking about the business.
Yeah.
And what are the assumptions? What have they tested? What do they still have to test? What are the things that they control? Do they know that they control them?
Important.
Yeah. And, how realistic do we think their goals are?
Yeah. How long is that process from initial introduction or the first call, let's say, to, okay, now we're ready to write a check for you?
Depends how much time we have.
You make it work on whatever timeline is required.
We make it work. Look, over time, I will say our diligence process, I think, has gotten much, much better in that we've gotten better at getting to the heart of things. So it's not that we're doing less diligence, it's that we're better able to focus on the most important elements. And we can usually make a decision within 1 to 2 weeks if there's time pressure and we have to, right? You reshuffle, you reprioritize. The part that often takes the longest is some of these prospective customer introductions. You reach out to some of these people, they're on vacation or they have another priority, and then you end up in the calendar tag situation, and that can extend the timeline. But those are, again, they're judgment calls that are context specific. With every deal that we make, we think through what are the key beliefs, the key risks, and the key hypotheses. So in some cases, those prospective customer calls are critical. We can't make a decision without them. In other cases, if they already have a roster of dozens of customers, we have other data points that can counterbalance that. We can shift how important that is. Yep. But, we try to be efficient. We try to make the process mutually beneficial to founders. But we also know that, you're fundamentally investing in these people, and it takes a while to get to know someone.
Of
course.
And
you learn a lot in the third or fourth meeting that you don't necessarily learn in the first or second. So I think we also are very careful to not jump the gun and commit to something where we just don't really know what we're getting ourselves into.
Yeah, you also face a bit the challenge of asymmetric information, right?
Always.
Obviously. And you do calls, so you get to know each other more, and there's so much information that you can get from just looking at someone's face, right? Compared to just reading pitch deck. What importance does a physical meeting play in that sense? Do you do that? Do you require that? Or is it just not, the time anymore to do that?
This is an evergreen debate on our team, and we go back and forth on it. And the frustrating reality is that you always feel better about your decision-making after you've met someone in person, but you don't actually know if you made a better decision or not.
That's a difficult spot to be in.
It's difficult, and you can't A/B test it. You will never have in your own portfolio enough data points to be like, yes, the companies we met in person outperformed those who we didn't. And so my inclination is if we can meet the founders, sure, but it's not a criteria. And we're not going to lose a deal that we think is incredible because the founder is, a 6-hour flight away and schedules don't work and whatever it may be. Yeah. And for me, one of the key learnings over all the years that we've been doing this is that you don't want to over-index on arbitrary criteria if you don't know that they're important. And we've seen that with multiple elements. You think initially, oh, well, you have to have some revenue. It doesn't matter if it's only $1,000, but you have to have some revenue. Well, why? Does that lead to outperformance over time? Sometimes yes, sometimes no. It's not actually a good criteria. And I feel similarly about the meeting founders in person. We just don't have conclusive evidence that this meaningfully improves investment decision-making. Therefore, it shouldn't be a hard requirement.
Yeah. I love that perspective. And that then, of course, directly brings me to the next question. What does meaningfully move the success of an investment? Like, what are some criteria that you say, this is an absolutely must-have or must-do?
We have to come to a shared understanding with the founder on what the short-term goals are and what the long-term vision is. Yep. And we validate that in different ways. There's the financial model walkthrough, the customer conversations, our independent research, references, all the things that we do. But fundamentally, we just have to both be very clear about what we're signing up for. And I think that's the biggest thing. When we think about cases where we would want to improve things, there's either things that we missed about the founder dynamic, for example. So it's important for us to see what that looks like. It's so hard to have one hard decision-making factor around it because we're mostly managing unknowns. What we really need to see is there market demand? Mm-hmm. Do we have signals that this is a high priority, urgent pain point for their customer base? Do we have signal that they're willing to pay for this? And is there a path where this company can have significant market share over time to drive a venture scale outcome? Yeah. So you need to understand, what's the hypothesis around defensibility? Why is this going to be hard to compete with over time? What's the go-to-market strategy? How will you grow quickly enough for a venture scale return, given the industry structure? And do we think that the founders have the right balance of ambition and realism to be able to actually get there?
Very important. Yeah. Well,
that's the hardest part.
I imagine. Yeah. Because you always want to be an optimist as a founder, right? And you think, yeah, of course, we'll get there. But you also need the realistic assumptions and the understanding what it takes to then walk the talk.
Yes. And I think the best sort of mental model that I have for this is you just have to break it down into like short term and long term. Yeah. And the short term is, what are the actual inputs over the next 6, 12, 18 months that you're going to put money toward? What are the outputs of that going to be? Will that be enough growth, which is an output? Often we see models where the growth is an input. Nope. You can't actually do that. You can't force it to grow. You do some things and then you get growth.
Right.
And then at the same time, right, you have the short-term, very concrete plan, and then the long-term upside potential.
Yeah. And along that process, I'm sure you've also seen many red flags. What are some of the most common or most dangerous red flags that you've came across so far?
I think the thing that ends up being a deal breaker for us in most cases is some version of what we call internally wishful thinking, where, if we just get one big client, then this, or if we are only able to capture 3% market share,
classic,
then that,
yeah.
Right? It's much more aspirational rather than concrete operational. And so for us, that's what we're really trying to avoid, the cases where hope is the strategy.
We had an interview with the UBS CEO a while ago, and there he said, luck is not a strategy. I think this is very well in the same line.
Exactly. Similar sentiment.
I also want to talk about a second topic. Now that we understand a bit better where you come from and how you operate and work, you are US-based VC. So yes. You're based in the US, but as you know, we are recording this interview here in Zurich. So I wonder, what brought you to Switzerland in the first place?
Everyone asks this question expecting a specific forcing function, right? Like something happened in my life. My husband got a job here, or we have a family member here, or we're from here. And I don't know. I think people have low expectations of personal agency these days. But, we both are fortunate that we have flexibility in our work setup and our remote work environment. And believe it or not, we specifically chose Switzerland and Zurich. we definitely knew just from a personal level that we wanted to move back to Europe, given we have family in Bulgaria. And then we really liked the balance and the opportunity of Switzerland and Zurich in particular. On a professional level, there's such a history of innovation and entrepreneurship. There's deep talent, both on the technical side and on the business side. Diversity of industry sector. So, everyone associates Switzerland with maybe watchmaking and banking. But of course, there's pharma, there's healthcare, there's climate tech, there's all sorts of different innovations. It's, of course, a hub for international companies who have some of their largest offices here. So, when we looked at it professionally, both from the VC side for me and on the software engineering side for my husband, there was just a lot of opportunity that we saw here. On a personal level, it's very easy to complain about the gray skies and the high cost of restaurants.
Of course.
But there's something so grounding about the way that the city integrates access to nature with an urban environment. You can be in the old town or at a museum and on a hiking trail and down by the lake within 2 hours on foot.
That's true.
And there's significant benefits to that. You have a strategic geographic location where whether you need to travel personally or for work, it's very easy to get anywhere in Europe and even in the US, which I travel to quite often. And so, yeah, I think there's just a lot of benefits there. And when you look at a place that has this history of innovation, this technological capacity, and the stability in both political and economic and institutional systems, there's a lot that I think maybe people day-to-day take for granted, but is a super strong foundation. So that's my love letter to Switzerland. Definitely happy to be here and grateful for the opportunity.
I think that's amazing because often we hear people leaving Switzerland for the US. You did it the other way around. So I think it's a very strong signal that Switzerland is able to attract smart and talented people like you and your husband. I think that's a very strong signal.
Well, thank you. I appreciate that. I think there are a lot of really incredible things happening here. And in some ways, the ecosystem almost feels like, particularly on the startup and tech side, it kind of feels like New York 10 years ago.
Nice.
There's definitely the underdog mentality.
Yeah.
New York obviously is very culturally significant and financially significant, but when it comes to tech and VC, it's historically been, the little brother.
Of course, yeah.
Maybe the third little brother after Boston, right, for a certain period of time.
Yeah.
So I think there's a lot of similarities in the vibe, I think.
So I now really want to talk a bit about the differences, but also the similarities between the US and the Swiss ecosystem. One thing is, of course, that stands out is the size. The sheer size of the country, of the ecosystem in the US is at least 50x, if not even more, the factor of Switzerland. Now, if you look at Switzerland, everyone often says we need to be more like Silicon Valley. We need to have bigger valuations, bigger companies. But my first question is, should we really strive for the same dimensions as in the US here in Switzerland?
Definitely a big difference in size, orders of magnitude. I think we're talking when it comes to capital deployed, single-digit billions per year in Switzerland versus hundreds of billions in the US.
Yeah.
But, you're also talking about a massive difference in country size. And I think the Swiss maybe sometimes don't give themselves enough credit for the per capita or size-adjusted innovation and fundraising. And, the country's holding its own when it comes to that scale. I think when it comes to questions around growth potential and size of rounds and valuations, my question is always why? To what end? And I don't know, my perspective might be in the minority because we're always the VC that's telling founders to maybe raise less money.
Seriously?
Yeah, when they're like, yeah, we got an offer for 8 million. We're like, 8 million? What are you going to do with 8 million? You have 300K of ARR. You don't know which customer base you want to focus on.
So I don't know, it just sounds good, 8 million.
Yeah, and I think there's always the allure, and there's the allure that more money solves your problems. But we've had many founders in our portfolio tell us it's just a different set of problems now. And we're very hesitant about scaling prematurely and over-investing and, frankly, wasting money on hiring teams without having the right direction and strategy and foundation in place. So even when I look at that at a more macro level, I think this question is both personal and policy related on a national level. On a personal level, I think for anyone thinking about being able to raise more money, like my first question would just be, what does that help you achieve? What ultimate outcome are you going for? What are you optimizing for? And is that the best path to getting there? There's nothing wrong with, capital efficient businesses that don't require a lot of capital. There's also nothing wrong with serial repeat outcomes at maybe not venture scale levels, but still excellent results. So I think that is always where I would start with that. And then, of course, on the national level, that's a whole nother set of questions around what trade-offs you're willing to make, what you want to incentivize, and how you want to structure your society. And, of course, the U.S. has had incredible world-leading outcomes when it comes to technological innovation. But there's also a cost to a lot of that. And that's just a question of values alignment and what you ultimately want to create for your overall society.
I like your perspective. It's a very refreshing one, and more is not always better. So a bigger round is not always better or what to strive for. Nevertheless, we often hear that it's quite easy to get early stage funding here in Switzerland. You have family, friends, some business angels, and you have 300K together. Maybe you also get a decent round afterwards for 1.5 million. But what we often hear startups, especially the scale-ups, complaining is, look, we now have a very great repeatable business model. We need way more capital. We need like 20, 30, 40, 50 million to scale to the next level. We don't find any investors in Switzerland. We only find them abroad. And then a big part of this upside doesn't go to Switzerland, but it actually also goes abroad to mostly American investors or Chinese investors. So that seems something that our companies, our scale-ups here are struggling with. What can we do to fix that? And should we even do something to fix that? Or is that just, well, that's how it goes. Once you're big enough, the money comes from outside of Switzerland.
I'm a very data-driven person. So I'm still in the relatively early phases of kind of peeling back all the layers to this into the ecosystem here. When you say when companies reach a certain scale, they have to look externally. They don't necessarily relocate, right? It's just that the people who do their growth rounds are investors in firms that are based internationally.
Exactly.
Is that right?
Yeah.
Understood.
I mean, we have like Antibiotics or Scandit. They're all still headquartered here, although they could easily move to the US or to Germany or wherever, but they all have big foreign investors financing their growth to a certain degree.
I think it's worth discussing whether that's a problem that needs fixing.
Right, yeah, and that's
maybe,
what we're here for.
Exactly. Maybe it is. Maybe it's not. And maybe the answer is somewhere in the middle. But I think when you reach a certain scale, you're probably expanding beyond the local market.
Probably even earlier than that.
Even earlier than that. And so there's benefit in having external investors who can help with that growth and expansion, who can make introductions, who can help you adjust to a local market and things like that. So from our perspective, because we are New York City based and most of the companies that we invested in previously were New York City, now they're all kind of scattered, they're all over the place, we have no geographic requirements. But we've always considered geography of investor and diversity of geography a benefit. So whenever it's possible, when we're putting together an investor syndicate, we're looking at who has complementary skills to us. So if we're better on go-to-market, we want someone who has product and tech expertise. If we're much more operationally focused and we're investing in healthcare, we want a healthcare investor. And especially if we are investing in a company that will have significant future capital requirements, all else equal, we would like to have a West Coast investor on the cap table with us because they bring a different level of access to future investors and a different perspective to that syndicate. So for us, it's a benefit to have that diversification. That's obviously a personal decision for the founders and the investors in these companies, but I would imagine that there are some benefits, at least, to having that international perspective.
And with that, it would then also make your company more valuable, and then also the returns for the existing Swiss investors will potentially be higher. Right?
Yeah. And it depends what return profile you're looking at and what layer of the capital stack you're evaluating, right? Like the return profile that an early stage venture capital firm like ours is going for is 3 to 5x net base with structural potential to do something nuts and be like a 10 to 20x fund, right? That's sort of, it's not something you can optimize for the same way you can't drive growth, But it has to be structurally possible the way that you've built this portfolio. If you're looking at growth stage, it's a different return profile. And if you're looking at the LP level, right, your aggregate return profile across your entire portfolio has, almost nothing to do with that outsized growth potential. You're looking to do, call it 8 to 10%, IRR if you're lucky in the aggregate. So there's always the question of, whose returns are you optimizing for and what's their goal? Because not everyone's goal is just to maximize ultimate return.
Fair enough. Yeah. And I like this perspective. Like, is it really a problem that we need to fix? So let's change the perspective a bit and say, okay, what else could we do to then help Swiss startups to raise bigger rounds, no matter where the money comes from? Because initially you said in Europe, when we came here for the first place, that you had this culture shock of people are not selling themselves well enough. And I feel that's also very true for Switzerland. We have amazing technology, but there we sometimes then lack this whole great success story and sharing and building up the fundraising story that we can also get investors excited. So what can we do to support more Swiss startups to raise bigger rounds to really fuel their growth, no matter where their money comes from?
I think the information asymmetry that you mentioned earlier is one of the key things here. There are just blind spots, I think, between what investors see and what founders see, naturally, because founders know their business and their industry inside out, but they don't necessarily know what anyone else's year-over-year financial statements look like the way that VCs do. So I think more transparency and more data around what is in market is useful. We have conversations with companies, even at the earlier stages all the time, where their perception of what would be great performance or good year-over-year growth might be true in the traditional business sense, but is not necessarily true in the venture-backed world.
Nope.
So there's an information gap to bridge to say, listen, if you grow 1.5x year over year, starting at a base of 300K, that's actually not really fundable at the next stage. It sounds
great, but it's not that great.
Right. It's great if you're a restaurant. It's not great if you want to go raise $3 million, right? And how do we get you to a place where you do fit those expectations? So, the later stage you go, the more metrics driven those decisions are. And in some ways, those markets become even more and more efficient, right? Because the criteria are much more objective and you have much more data that you can use to make that decision. So I think having more of that information and more of that connectivity between startups based here and the investors who would be doing those later stage rounds, even just as context, I think would be helpful. And there is definitely an element of positioning and storytelling, and that does not stop at Series A or B, right? We see this even with companies that are public, their quarterly earnings reports, they're still selling.
You're still on the
this
spot.
Big vision.
Yeah,
Exactly. And, one of our portfolio founders asked us a while ago, she was like, be honest with me. How much of your job is just rewriting founder emails into VC language, right? Because they'll send me something and I'll be like, don't say that. Like, I know what you mean, but that sounds like the opposite. You should actually rephrase it this way. That's a weird term. They'll be more familiar with this one. And so I think there are, again, ways to kind of leverage that information to make sure that you're speaking effectively the buyer's language. It's not about presenting something that's not true, but it's figuring out what the threads are that you need to pull on, what to emphasize, what to focus on, and how to kind of put it in market for what those investors are used to seeing.
Absolutely. And then my big question is, like, how can we improve that? Because it all makes a ton of sense, what you're saying, and the great VC makes all the difference. But on the whole ecosystem level perspective, how can we structurally improve that? Do we need more people like you moving here from the US?
I think you do need a certain amount of people who are willing to provide that perspective and that feedback, right? I don't know that they necessarily have to move, although it would be fun.
But also they need the experience as well, right?
They do. We've spent a tremendous amount of time over the years doing open office hours, mentor meetings. We used to host our own every single week, 2 hours a week. We would just meet with strangers and just give them feedback on their decks. Now we do it through partner organizations so that there's a bit more repeatability and scale to it. I think it would be great if other investors at later stages spent more time doing this. And some of them do, right? As part of their kind of ecosystem giving back, and also as part of their selfish pipeline building.
Of course. But it has to be a win-win as well.
It has to be a win-win, exactly. Yeah. And I think it's probably hard to do kind of on a structural level of like, here's an initiative that will fix this. I think what founders can do is, first of all, they can help each other. So having that peer network where you have not just people who are exactly at your level, but one step ahead, one step behind, that kind of community and ecosystem, similar to what you're building at Swisspreneur, I think is super valuable. And, you also, you have to have mechanisms for getting feedback from the investors in real time. Sometimes your own investors can facilitate that, right? Where, they know Series B investors. When they catch up with them, they'll get the latest from them. We do a lot of that information gathering. But it's also valuable for companies to for founders to think about how they're building those relationships and getting that feedback before they're going to pitch those VCs.
Makes a lot of sense. And you just gave me an idea. Maybe we could organize something like that where we bring VCs, no matter maybe from the US or something, to provide free feedback to Swiss startups. I think that would be a cool gap to fill. Basically,
absolutely.
You already helped the portfolio company of ours very, very much. And I think we could try to do that at a bit of a bigger scale. I
think there's a lot of opportunity for that. And again, some of it will be universally applicable, right? Here's the benchmarks for what we're seeing in best-in-class B2B SaaS companies or best-in-class healthcare companies at Series B.
Exactly.
Here's the last 5 deals we've done. Here's where the bar is. And some of it will be more bespoke, right? Which is based on your industry, your sector, your pitch. Here's what's clear. Here's what's not.
Wow. Yeah. We'll work on that. Maybe we'll launch a pilot soon. Exactly. I would love that. Now, if you look a bit into the future, you currently have invested in more than 30 companies. You have $130 million of assets under management. So what is next for Laconia? What are your plans?
We are nothing if not consistent. So we're very excited to celebrate our 10-year anniversary this summer.
So cool.
If the markets will let us, we want to do this for another 10 years. So that's our plan. We've always been pre-seed, seed, B2B software focused, companies solving mission critical problems. We love what we do, and we're going to keep doing it. Takes a long time for the feedback loops and venture to play out, but I think we're on a good track.
Absolutely. And 10 years is probably the minimum it takes.
At 10 years, you're starting to see signals that maybe you're not bad at this.
Amazing. Geri, to wrap up the conversation, we also have some rapid fire questions for you. I'm just going to fire them right away, and you have to answer in maximum 1 sentence. You ready?
Ooh, 1 sentence.
Let's see.
All right, let's do it.
We're not that strict, but let's see. What is the best fundraising resource or tool that a startup can use? Do you have any top recommendations?
Fundraising success is all about momentum. So I think the best things founders can do is have a strong list and a tight process. So for that, I'd probably recommend Crunchbase Pro and LinkedIn.
Love it.
Keep it simple.
Exactly, but be consistent. Do you regret making an investment or regret not making it?
With VC, you're always trying not to over-index on your previous PTSD.
Yeah.
So there's definitely investments where we missed things. And in those cases, at the time, we made the right decision as per our decision-making process, but then a critical factor about the business changed. So we were right when we made it, but then the company pivoted or expanded their market or did something different. And it turns out that now we're wrong. So I think the learning for us there is you want to focus not just on evaluating the company at the time of investment, but make a decision based on where they're going and whether your vision is aligned with that.
I mean, that's almost a philosophical question then, like you are right. And you also have to be very neutral and objective to say, here we were right, but then something changed and now we're wrong, but that was not miscall from our side. But then you're almost in a philosophical question where you say, isn't that all a simulation, right? Can you really influence it?
Exactly. I think the tactical thing that we do in those situations is we just give the feedback even during the diligence process. Here's our concern. We think that this go-to-market strategy is not going to work for these reasons.
Yeah.
What do you think about that? And if they dig their heels in and they're like, nope, we think this is the way, then, you pass.
Of course.
But if they say, that's really interesting, hadn't thought about it this way, someone else mentioned this to me last week, I'm going to dig in and see what we can find about this.
Oh.
That's a very different response, right? And then you decide, is that risk palatable to you? Are you willing to take the risk that their current go-to-market is probably not going to work, but they're open to finding a different one?
Yeah. And another great gold nugget, I feel, to see how investors think about startup founders' reactions.
Yes.
What is the most memorable investment so far for you?
A company called Ocrolus. It's a fintech company in our second fund. It's the first investment that I sourced. And, well, I guess in some ways you never forget your first one.
Yeah.
But they were the most expensive deal that we had done at the time when we did it. And then they grew like wildfire. They raised tens of millions of dollars, but more importantly, they generated tens of millions of dollars in revenue. And that was the first investment that we had in the portfolio that had reached kind of that breakout venture scale potential.
Wow.
So it was a good validator both for our fund strategy and then candidly for me too. I was like, oh, I found something. Maybe I'm not bad at this.
Yeah. I mean, you need these feedback loops, right? But they take a while until you see them.
They take a while.
And you have to stay sane along the process until you get there. What is the best return on investment that you got so far?
Fund one portfolio company called Promote IQ, retail tech company. We invested in it 2 years into the fund life cycle. 2 years later, Microsoft acquired them, big exit, returned our first fund.
Wow.
4 years into the fund.
Amazing. That's like the dream outcome.
Good outcome. Good
Wow.
outcome. We're now investors in the founder's second company. So hopefully next time you ask me this question, I'll have a better answer.
I love that. And the last question, it's a very mean and a tough one. Switzerland or the United States?
See, you're lucky that I have had a lifetime of training answering this question from relatives. What do you like better, Bulgaria or America? So I'm prepared for this.
Okay.
I genuinely think that you have to experience both places to be able to appreciate each one fully. So I encourage anyone who has the opportunity to immerse themselves in these ecosystems. I think there's a lot to learn from each one, and I'm very, very grateful to have the opportunity to straddle both worlds.
That's almost a very diplomatic, neutral Swiss answer, I would say.
So I'm adapting well.
Exactly. Geri, thank you so much for your time and for all your amazing insights. All the best, hopefully with the next full fund return very soon. And I'm sure we're going to hear and see much more from you here on Swisspreneur. Thank you for being here.
Thank you. Really appreciate it. Enjoyed the conversation.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.